If you've ever said to yourself, I need to be more disciplined with my risk, you're probably looking at this the wrong way. You see, a lot of people blame their inconsistency in their performance on psychology. They blame it on their risk management. The thing is, a lot of it's down to the fact that it's bad risk management. And trying to be more disciplined with it is not going to help. And the reason it's not going to help is what I mean by bad risk management is the vagaries that people use to describe it. So for example, people are told, cut your losses quickly. Well, what do you mean by that? Do you cut your loss as soon as the market goes, as soon as the trade goes offside? How soon is quickly? It's vague. People are also told, let your winners run. And that's all well and good, but where do you run it to? If you don't have a target, you can let your winner run and run and run until it comes back. People have the attitude that markets always come back, which is another reason people don't use stops, and they assume that it will come back to them. So that would work the same when you're on side on a trade as well. So that idea of letting winners run and cut your losses quickly is a vagary. The other one, the classic that I hear, is use tight stops. Well, how do you define a stop as tight? Is it based on a number of ticks? Is it based on an amount of money you don't fancy losing? These things, again, are not methods to manage risk. Risking 1% on a trade. Is that 1% of your day, 1% of your whole account? And also, from a 1% perspective, are some trades worth more than this? Are some trades worth risking 2, 3, 4%? Quite possibly. That's what I mean by bad risk management. The other side of bad risk management that people don't often think about is the side that risk management is not just about limiting losses. Risk is not the same as loss. And good risk management also requires dynamic sizing, increasing your size at certain times, understanding when a trade becomes asymmetric. These are the things that improve your risk management. And crucial to all of this is an actual process for how you assess risk on any trade, how you structure the risk that you're taking throughout a day. That's proper risk management. Not using vagaries, but having clear process and clear reasons why you do certain things, when you do them, and how you size your trades accordingly. Tuesday, the 23rd of April, I'll be running a workshop at 6 p.m. where I'll be covering risk management, looking at how to place stops to give you clarity on where your risk actually lies and what size you can actually take on these trades. I'll be talking about how and when to size trades up and what exactly I mean by asymmetry. This will not be thinking of things just in straight risk reward perspectives. This is how traders really manage their risk. So if risk management is perhaps one of the things that you find you're struggling with, click on the link, turn up on Tuesday, the 23rd of April, 6 p.m. I'll see you there. We'll cover risk. See you then.